But I think most of these things you have to say these are not things that will have an immediate effect. I mean, the plan for growth is one that will come to fruition if it comes to fruition over time. It's not something that suddenly snaps the economy into action. Was this a big tax reforming budget? Well, there were some tax reliefs that were abolished. The Office for Tax Simplification, a new body, they identified 1,000 separate tax reliefs in the British tax system. Extraordinarily complicated tax system we've got. But what they also found was that most of them are there for a purpose. If you suddenly remove a tax relief, then you're suddenly disadvantaging people who've come to expect it and have come to do things on the basis of that tax relief existing. So having identified 1,000, they said that 155 were ripe for removal, 43 of them went yesterday in the budget. So that's welcome. Tax and national insurance, as I said earlier, the administration is being merged, but not as yet the taxes themselves, and HMRC is going to see whether the 50% tax rate brings in any net revenue. I think it's a difficult exercise for them to do, because how can they know about people who've been deterred from being based here because of the tax, people who've decided to move overseas because of the tax, from the city and so on. Very difficult analysis to do. In straightforward terms, I would expect HMRC to say it does bring in a bit of revenue, particularly because of the clampdown on pensions for higher earners. But we'll see. I don't know whether it's an exercise that they are necessarily that well equipped to carry out. And we've got some existing measures, which are welcome. Helping business angels to put money into businesses, doubling entrepreneurs' relief. But all of those existed before. I wouldn't say this was a true reforming budget in the sense of things coming out of nowhere that we hadn't expected, and we all step back in amazement and say, what a great reformer he is. It wasn't really that kind of budget. The growth plan, this is motherhood and apple pie, really. So 4 aims there. You may say that they are wishful thinking. Of course, we want the most competitive tax system in the G20. We want, Britain to be the best place in Europe. I mean, the Conservative government and John Major used to, say our aim is to make us the enterprise centre of Europe. 20 years on, we're back to that same aim. Rebalancing the economy, of course, we can't rely so much on consumer spending and government. We have to have more investment in exports, and to create a more educated workforce that is the most flexible in Europe. I think we've got a flexible workforce. People will have different views in the room about whether we've got a well-educated workforce, but there's clearly work to be done there. On most of the international comparisons, we've slipped down the league tables in terms of educational attainment. So, and again, that's something that takes a generation. It's not something that can be done even within a 4 or 5 year parliament. Where are we in terms of where does this leave the economy? I think it's sometimes easy to forget how bad things were even a couple of years ago. So we go back to the autumn and winter of 2008-9. We almost didn't have a banking system. We almost had the onset of a new Great Depression. So things were extremely bad only 2 years ago. So we're in a fairly early stage of convalescence, of coming through this. People want things to happen much more quickly than is often practicable. It takes time to get over shocks like this. And in terms of the shock, I mean, this was the first, the first and worst real recession of the post-war era. We've had plenty of recessions in the post-war period where global growth slowed very sharply, and we saw global growth slowing maybe to 1%. This time, 2009 was the first year in the post-war period where global GDP actually fell from one year to the next. So that hadn't happened before. And I think the significant thing about what happened in autumn 2008 was that every economy in the world slid together. This was a coordinated global downturn. Most world recessions aren't like that. Most world recessions You get America, say, going into recession first, 6 or 9 months later Europe does, a little bit later Asia does, by which time America's coming out. You get a ripple effect. This was everybody going down together, a very sharp and scary decline. World trade was part of the transmission of that collapse. It all happened, of course, after Lehman Brothers failed, and for a while world trade was falling at a more rapid rate than the onset of the Great Depression. In 2009, world trade fell by 12%. Previous global recessions in the post-war era, we'd only seen 1 or 2% fall. So this was a very serious drop in world trade, much worse than we'd seen in the post-war era, and for a while, worse than at the onset of the Great Depression. In terms of the UK economy, we had this very, very long upturn, a record upturn, 16 years from the recession of the early 90s to the recession that began in early 2008. 63 consecutive quarters of growth. We will never see that happen again. The previous record was 19. That we'll never see an upturn as long as this. And maybe that's a healthy thing. Maybe you need small recessions every so often just to remind people that there is a downside as well as an upside. Share prices can go down as well as up. And followed by, as these things are, what on current evidence was the worst recession of the post-war era, as with the world. So just to give you some numbers, in the recession to 2008-9, GDP fell by 6.4% from peak to trough. In the early 1990s, which most people will remember as a pretty bad recession, it was only 2.5%. In the early 80s, which saw a lot of manufacturing industry go forever, it was 4.6%. So these figures are prone to revision, but on current evidence, on the current statistics, the 2008-9 recession was the worst in the post-war era. And important hangovers from this: one is the state of the banking system. Despite the rescues, despite the support, we're still in a period of what some call creditless growth. Banking capacity before the crisis, bank lending credit seemed to be on tap. We regarded the banks as sort of giant utilities which just pumped out credit. 10% average annual growth in the run-up to the crisis. Then you run into a period where the crisis hits. And then bank lending is actually in decline, banking capacity is in decline, for three reasons. One is that the banks themselves have become much more cautious about lending. Secondly, they're required to be more cautious by the regulators. And thirdly, and this is particularly the case in the UK, we had many of the foreign players that we had in the UK banking system, particularly in the SME market and in the mortgage market, are no longer here. I mean, you think of the presence of the Irish banks, for example. They're no longer here. We've lost banking capacity that way. It will take time before the banking sector comes back in the way it was before the crisis. Second problem, of course, we've got high levels of private sector debt. And I always find that the interesting thing about private sector debt and the way people think of private sector debt, we tend to think of household debt. And household debt is important and went up quite a lot. A lot of people borrowed quite a lot of money. Company debt went up quite significantly. But the big increase in debt, and by far the biggest increase in debt over this long recovery period, was in the financial sector itself. The financial sector lent back to itself, and the 2/3 of the increase in debt in the UK, in private sector debt in the UK from the early 1990s, was in the financial sector. That shouldn't really happen. I mean, you would expect the debt build-up, if it's happening anywhere, to happen in the household sector or the non-bank corporate sector. And of course, very sharply rising government debt now. And if you wanted to get really scared, you'd do what the Office for National Statistics does in another chart, which is add in the liabilities of RBS and Lloyds to that figure, and you get public sector debt of 155% of GDP, not 60%. But public sector debt has clearly gone up an enormous amount. So growing through the banking hangover, the fiscal hangover, and the private sector debt hangover is the challenge that we face over the next few years. However, if that's made you feel slightly depressed, let me welcome into the room the spirit of Norman Lamont, chancellor in the early 1990s, famous spotter of green shoots which nobody else could see, but in fact at the moment there are plenty of green shoots around, plenty of reasons to be concerned as well, as James alluded to. But in terms of the global economy, you know, a lot of the analysis you sometimes read or hear, people will talk about, you know, when will the global economy start recovering? Well, the answer is these are the PMIs are purchasing managers' indices or purchasing managers' surveys. They measure business-to-business activity. And when these indices are below the 50 level, you're in recession. When you're above, you're in recovery. And as you can see, the recovery is almost 2 years old now. So after that sharp fall in the global economy from the autumn of 2008 to the spring and summer of 2009, we've seen pretty well 2 years of upturn. So the global economy began recovering in the summer of 2009, and more importantly, it's been a pretty strong recovery. So before the crisis, we had global economic growth, which was considered a bit too strong, of around about 5% a year. And people said, we'll never get back to that. You know, and organizations like the IMF, and this is in fact their chart, said that 2%, 2 to 3% global growth was likely in the recovery period. In fact, we had 4.8% global economic growth in 2010. The IMF, admittedly, before the Japanese earthquake, predicted 4.4% for this year. It's been a pretty strong global recovery. And if you think about all that debate about whether, you know, the recession and recovery would be U-shaped, W-shaped, saxophone-shaped, square root-shaped, and all those things, bath-shaped, VW-shaped, somebody suggested. So far, it's been a V, and it's been a pretty strong V. The same has happened for world trade. Again, you know, the fear was that you would get a new Great Depression, you get protectionism of the sort we saw back in the 1930s. World trade would never recover to its previous levels. It has done so, and it's done so remarkably quickly. So after that 12% fall in 2009, we saw world trade grow by between 12 and 13% in 2010. A remarkably rapid bounce back. And this is very positive for the UK. We're an open economy. You know, it's not just in the Victorian era that what happened in the rest of the world influenced what happens in the UK. When the world economy is doing well, Britain will tend to do well as also. So this is very positive, I think, a very positive sign. However, you know, as James alluded to, there are global challenges there. One of which, I mean, the most obvious indicator of the tension in the Middle East and North Africa, apart from the fact that we are taking part in the action against Colonel Gaddafi in Libya, is the oil price. And the oil price was, you know, after rising to $147 a barrel in the summer of 2008, fell very sharply when the crisis hit, dropped below $40 a barrel, crept back up, but we seem to be in a pretty steady $70 to $80 a barrel range, which was okay. Then you get the uprisings in the Middle East and North Africa, which nobody really predicted, and the oil price goes well above 100. It's about $115 a barrel now. So this is a significant challenge. Another one, of course, is the terrible events in Japan. Now, I think the consensus is, some people think it's distasteful even to talk about the economic effects of events like this, but the consensus is that this will have, a nasty short-term effect on Japan's economy. Japan, remember, is still the third biggest economy in the world, significant economy, but for the next 2 to 3 months, it's obviously going to be in some difficulty. However, previous experience, including the Kobe earthquake of the mid-90s, suggests that there is then quite a strong reconstruction rebound, which I would also expect to happen this time. However, it's a challenge that the global economy, certainly the people of Japan, could have done without, and the global economy could also have done without. We've got the situation and the developing situation in Europe. We've already had 2 substantial rescues in the Eurozone, Greece and Ireland. It seemed that that Europe was getting to grips with this crisis, and that things were starting to, the authorities were getting the upper hand over the markets. But then you get yesterday's vote in the Portuguese Parliament, and you have difficulties there. So I think these flags are Portugal, Spain, Belgium and Italy. People, I'm sure somebody will correct me if I'm wrong, but they're all sort of countries in the Eurozone in potential danger, and of course Portugal is in the most immediate danger of needing a bailout. So these are challenges, and they are significant challenges.